Hope everyone had a lovely lunch and caucus experience. We are going to spend the afternoon in some real orientation, starting with Abby, who's the main attorney we work with. Though we get, one of the pleasures of being in here is that we get to touch every policy area. So we get to spend time with almost every member of the staff by the end of the session. And then we're going to talk about principles of a high quality tax system, which is something that I really appreciated how last biennium Representative Odie would sort of always bring us back to those principles when we were struggling to find our way through. And so it's a helpful guidepost to keep in your mind as we're moving forward. And then the tax department is joining us to just meet them all and tell us what they do beyond just the basics of they collect the revenue. And then Sorsha has kindly agreed to take us through just like the basics of our website and the JFO website and some other orientation that we didn't cover last week. So, and we will wrap up by 4:00.
Cool.
And so with that, there's some posting problems happening with the website. And so the first document that Abby's taking us through, we all have in our email, and will get posted as soon as the internet fixes itself. Have we all introduced ourselves?
I don't think so.
Okay.
First time I've been in person for a couple of years, actually.
We're gonna do a little go around. Nice to see you in person. So I'm Representative Kornheiser, the chair.
Bill Canfield, Fairhaven.
Julia Andrews Westford.
Catherine Scrappsbury.
Jim Masswood, Deptford.
Scott Beck, St. Johnsbury.
Chris Mattos, Milton.
Kurt Taylor in Colchester.
Peter Anthony, Barrett City.
Carl Odie, Burlington.
Carl Demrow, Corinth.
And Representative Brannigan can't be here today, but she'll be here tomorrow.
Great. So for the record, Abby Shepherd, Office of Legislative Counsel. Many faces are familiar. I do actually remember Representative Brannigan from her previous service when she was in the House. My background is that I served in 2016, in that session, as a law clerk. So that was when I first began working with the legislature. I did about 3.5 years at the tax department after that. And then I've been back since 2019. So at the very end of 2019, right before COVID. So I've pretty much done most of my time in this role remotely. So I'm not sure I've actually met Representative Mattos. Some of you have only seen on a screen before. So this is nice to actually hear in person. And I'll also be getting sort of up to speed. I assume you don't want any projection. Okay, great. Okay.
If you ever are doing something where you feel like it would be much easier for you to do it that way, please let us know. But generally, we're going to default to our own.
Sure. So this is very sort of emblematic of the type of work that I'll present to you. So whatever is the easiest for you, it's either a legal memo or PowerPoint, or occasionally I'll show like a tax form or something that you might just want to follow along on your computers. So to start it off, the first presentation that I'm going to go over is something that has been sort of historically brought up in the first year of the biennium for the committee. And I do, just before I even get into the memo, want to sort of clarify some of the lines between legislative counsel and the clerk's office. So I will talk about your jurisdiction under the rules, but that is really a clerk area. I can't advise on procedure. Legislative counsel doesn't determine, for example, where bills are committed. Even though we're drafting the bills, we don't make those decisions. But I think it is helpful, especially with the resolution that just passed last week, to see the way that your committee's jurisdiction was amended slightly. And then what is sort of more within the legislative counsel role that I'll cover is there's this one court case that was brought, I believe in the 70s, 74, relating to jurisdiction of the House over revenue bills. So I thought that was just interesting to give you that background. And it actually looks a lot longer than what I will cover, because I provided a lot of the basic constitutional provisions that relate to your committee and to tax laws, but it's not exhaustive. As I was going through this, I could think of a couple of other primarily US constitutional provisions like equal protection, due process, but I didn't want to bog everyone down with that because it could be unending. So this gives you really the basic framework for what your committee will be working on. So the Vermont Constitution does require the legislature to observe certain procedures and standards when it enacts taxation and revenue laws. Those are not required for other types of legislation, so your committee does have other constitutional restraints other committees do not have. The primary constraint that is placed on your committee is that all, or really the General Assembly as a whole, all revenue bills shall originate in the House of Representatives, but the Senate may propose or concur in amendments as on other bills. And this is where the court case comes in 1974. Andrews v. Lathrop found that a bill that has as its primary purpose providing tax relief to certain taxpayers and for which the primary purpose of the taxing provision is to raise revenue, specifically to fund a tax relief program, is not considered a revenue bill within the meaning of the Constitution of Vermont. A revenue bill is one whose primary purpose is to raise revenue. So sometimes you might hear either a challenge from the Senate or the challenge from other representatives as to whether a bill can originate in the Senate or whether it can originate in the House. Ultimately, the Supreme Court did say in this decision that it will defer to the General Assembly to interpret its own rules. But generally, as long as it is a bill that is just amending an existing revenue source or is providing tax relief in the form of a credit or an exemption, that it is appropriate to start in the Senate. Again, that sort of determination is ultimately up to the Secretary of the Senate or the House Clerk. So just some of that interesting back and forth, which hasn't really come up in the last 40 years.
And what I see here is this idea of not bills which create revenue incident to other purposes.
Correct.
If it's, a massive policy bill that then has some revenue to pay for it, does that also?
That is
And
one
originate either?
excellent example of that is the cannabis bill that passed that did originate in the Senate, and that was within a much larger policy discussion.
Thank you.
And that created an excise tax. The Constitution also imposes a super quorum requirement, so that a tax or revenue bill must pass with enough support in the House. The representatives, a majority of whom shall constitute a quorum for transacting any other business than raising a tax for which 2/3 of the members elected shall be present. So that means for tax revenue bills, 2/3 of the members who are present must vote in favor of the provision. And that's specific to the House. Unlike any other type of legislation, the entire legislature has to deliberate on the cost benefit of raising the tax. So this is within Article 9 of Chapter 1 of the Vermont Constitution. Previous to any law being made to raise a tax, the purpose for which it is to be raised ought to appear evident to the legislature to be of more service to community. I should put a little stick in there. I would want to say to the community, then the money would be if not collected. So the part of the deliberations and part of the purpose of raising a tax, there's a constitutional requirement that it be of more benefit to the community than if it were not raised. Okay. I don't know if there are any questions about that or if there's anything you've encountered in your experience with bills on the floor or deliberations. I think that's a lot of the meat of what your committee will discuss, whether a tax should or should not be raised.
I guess all of those other provisions also are defining a tax or a revenue bill as narrowly as in the originating bill conversation, the originating body conversation?
Yes, that was the Supreme Court's interpretation of the rules. It did also look, I'm sorry, I didn't bring the case with me. It did also look at sort of the historical origins, and I could send you a little excerpt talking about English chambers, how their parliament works, and how that's, having a bicameral system. The purpose is to have some jurisdiction is more appropriate in the House historically than in the Senate. It's about as much as they went into depth about that. So the Supreme Court decision was narrowing what revenue means so that the Senate can propose amendments to taxes or credits that are already existing. In terms of the rules of the House, as you're all aware, this was just amended. It wasn't really a substantive change to your rules. You are still committed bills that affect the revenue of the state. It requires the committee to report the amount of, to consider bills that report the amount of taxes necessary to be raised for the support of government and inquire what measures, if any, ought to be adopted. And those were the only real changes. I think it was more of a wordsmithing change to my understanding. And so to sort of summarize what is under that House Rule 25 is that the bills that are typically referred to your committee are going to include anything affecting the revenue of the state, raising or reducing taxes, affecting revenue by any other means such as fees, and measures that affect local and municipal taxes, including the property tax grand list that is specifically noted in the rule. There is also a note here about House Rule 35A, which makes the House Ways and Means Committee an automatic committee of reference for a bill on any subject if the bill also affects state revenues. And I don't want to read through the whole thing and bore all of you, but just so it's clear, you will have a lot of bills around crossover. If anyone has anything affecting revenues, whether it explicitly says that it does or not, some bills don't come with a revenue source. They will be committed to your committee. And then also, and this is more in terms of timing, as our office does draft bills, we will be reminding you of deadlines as they approach. But as a committee under House Rule 40 subsection C in the first year of the biennium, although any committee may request a standard form bill, so that's a full bill with language, not just the statement of purpose like in a short form. In the second year of the biennium, Ways and Means, like the Appropriations Committee has sort of an exception because it's the end of the biennium. Your committee can introduce a bill at any point. And that's also to allow you a little more flexibility as you're getting all of these other bills, how you want to handle them and at what point you want to act as a committee, create a committee bill. And so that's the extent of the review of the law there. Again, I've provided sort of as an appendix some of the primary constitutional provisions. I will refer to some of these often, particularly the if we're talking about education property tax, the right to education, the common benefits clause, and also the proportional contribution clause in the Vermont Constitution that requires all taxpayers to contribute equally. And then there are a few, the first page sets out the US constitutional provisions, which I could just briefly touch on. A lot of you are familiar with these. That the US Constitution is the supreme law of the land, so state law superseded by federal law, that the US Congress has the power to regulate foreign nations, interstate commerce. It also states that states cannot discriminate against individuals who are from outside of Vermont. That's often an area where I think legal advice is often required, where there's, you want to support Vermonters, and sometimes that's where you can get into trouble with potentially a privileges and immunity clause issue if Vermonters are being benefiting in a way that might be seen as discrimination against non-Vermonters. That's just sort of an area that's often flagged as somewhere to be careful of in terms of constitutional requirements. And then lastly, states cannot tax imports or exports or discriminate against imports or exports. And as what's not listed in here, as well as due process, equal protection, Vermont's proportional contribution clause actually uses the same analysis as the federal equal protection, which requires taxes to have a rational basis, which is not a super high standard. It's that taxes, when they're enacted by a state, have to have a rational basis. They can't be arbitrary or capricious. Those are really the big overarching constitutional principles, and that's what your committee will have, as you'll be getting a lot of bills very soon.
Thank you. Doesn't look like there are any questions.
Okay.
So we can jump into the next stage.
Great. Emily, would you like to follow the same? Yeah. So we had, some of you did attend the Tax 101, so we will be presenting more or less the same information. It'll be a review for some of you, a primer for others. Emily will start with the principles of a high quality tax system, and then I will walk you through sort of the nuts and the bolts of what is a tax, what are the different pieces to a tax.
And the documents are now up on our webpage, but you might need to refresh in order to see them. And Emily, you're welcome to, is there not there no other chairs in this room?
Just another one.
Oh, great, okay. You two are welcome to sit together too, if that's easier than flipping back and forth. Okay.
Here you go, we'll go through my thing and then Abby will go from there. All right. So for the record, Emily Byrne from the Dwight Fiscal Office. Good to see you all again. As Abby said, we're gonna like kind of rerun through what we did on Friday. But I was thinking I would probably provide a little bit more color to some of the slides and, give you folks, or I'm happy, it's okay to have people ask questions throughout so that we don't have to go through the whole thing. And if there are things that come up, we'll have a conversation. I brought my notes so I can write down questions I can't answer as we go through this. So we're going to start with the principles of a high quality tax system. And I think it's helpful to go through this too, because I'm going to try to use these sort of 6 principles as a framework for a lot of the tax 101s that we're going to go through over the next couple of weeks. So that there's sort of some consistency. There's a thread that sort of feeds through personal income tax, sales tax, corporate tax, et cetera. You kind of keep seeing those things because I think as, tax policy gets developed throughout this legislative session, really sort of unbalancing these things is going to be important for you all as you're making policy. So I'm on slide 3 of my presentation, and this is just a reminder. Right, Emily didn't make these up. These are sort of the NCSL. These are presented in NCSL's tax policy handbook, and they are, if you want to read more in depth about each of them, it's a good tool. It is from 2010, but it's still sort of those general principles still apply. And it's good information. So as an overview, right? So the 6 principles: sustainability, reliability, fairness, simplicity, economic competitiveness, tax neutrality, and accountability. And I'll just go through each one of those individually. So sustainability and reliability. This is really just making sure that the taxes that we have are sort of predictable year over year. They are reliable. I think one thing I forgot to mention when I was here last week when we were talking about sort of the revenue update, right, is that this committee is one side of the equation, right? And your colleagues on the appropriations committee are anticipating that they know that the revenue that will be raised won't be available over multiple years, and that they can sort of count on as they're developing spending plans, that the revenue that sort of is behind those spending plans is available year over year. So yeah, that reliability is that it's predictable too, that we know sort of what's going on, and we know what's coming. My sort of funny story, I don't know, when I was at the Agency of Natural Resources, I got to help do the Clean Water Fund balance sheet and those sorts of things. And it was new at the time. And we were sort of, what kind of reserve do we have to have in that fund? What do we need to think about? And at the time, I remember going to the tax department and asking them, what do I need to be worried about in terms of volatility in the meals and rooms tax, property transfer tax, et cetera? And the tax department, oh, meals and rooms tax, that one, nothing ever happens in that. The economy is down. People still go and buy alcohol and drink. The economy's good. People go out to dinner. Don't have to worry about anything. Meals and rooms tax is usually one of the most stable revenue sources. But they did not predict in 2018, was that 2 years later, there is a scenario, turns out, when there's a global pandemic, that the meals and rooms tax is not so reliable. So it was an interesting learning experience for me. And I just put that out there as a sort of when you think, oh yeah, that one's, people are always going to buy stuff. It'll be fine. There is a possibility that there may be some sort of fluctuation that happens that impacts whether or not those revenue streams are reliable. So one of the one that's sort of I shouldn't say that. When we think about sort of reliability, the corporate personal income tax, those are really economic, tied to the economy, tied to the labor force, those sorts of things. So as things are, if a recession comes, there's a possibility that we may see some impacts to things like personal and corporate income tax. Granted, given the unemployment rate right now and the way wages are going, maybe if there is a recession, it will be fine. Who knows? But those sorts of just sort of being aware of economic conditions and the impact it can have on individual tax types is important, and making sure that there's balance when you have those sort of peaks and troughs in the economy, that they are balancing each other out. And similarly, reliability from the taxpayer side, right? As a taxpayer, I want to know generally what I'm going to pay in taxes next year, or what to expect when I go to buy something, what I'm going to pay in sales tax. And don't want that to change year over year, or as a business trying to plan and budget for the next couple of years out, sort of what I can expect in state taxes. In the next sort of in that bigger umbrella, the sustainability idea, right? So it's not one time. And on the budget side, we always talk about, you don't want to have ongoing expenses balanced by one-time revenues. So you want to make sure that you're mitigating. There are things that will happen in the economy or with individual taxpayers that will cause ups and downs in revenue that we bring in, but generally you want to make sure that it's not one time. And where possible, you want to match. I think the budget folks often bring in the alligator chart at some point, probably after the governor's budget is presented, right? But it kind of shows revenue growth is X and expenditure growth is X plus, and trying to bring those two things in alignment is critical to make sure that the budget is in balance. You know, we'll talk about this more when I bring in personal income tax. That's a sort of sustainability piece comes in when you think about the demographics of Vermont and sort of the changing in who's employed and who's paying personal income taxes and who has wages. And to the extent there is an aging population and fewer people are sort of part of the workforce, that sustainability, you know, in the short term makes sense, but sort of over the long term, what's going to happen to personal income tax as if the trends of the shrinking workforce kind of continue over time? How do we balance that? And then we talked about this one a little bit, but the sort of diversity in the tax base. So making sure that it's broad enough to mitigate those sort of ups and downs in the economy and people's behavior changes, to increase reliability, and having just a mixed bag, right? I use the all your eggs in one basket analogy last Friday, but that's really I can't come up with a better analogy other than you don't want to drop the basket if all your eggs are in it, right? So the next slide, right, is just a picture of that, right? Vermont does have a really diverse revenue picture, which helps mitigate some of that variability in each tax type, depending on what's going on in the economy or wherever else. So we're about a third property taxes. Most of that going to the education, all of that going to the education fund, with the exception of the property transfer tax. Income taxes are another third. Consumption taxes is about 30%, and then other sort of fees and other taxes making up the remainder of that. It's kind of a nice third picture. So if there are no questions on that one, I'll jump to fairness. So fairness, right, is making sure that there's equality in the taxes paid across taxpayers and that have the similar ability to pay, sort of in similar circumstances. We break it down into sort of two components: horizontal equity, so meaning that two people in the similar economic circumstances have the same tax burden. I'll use the same example, but you have two married couples with both have an income of $60,000. Horizontal equity would say they should pay the same in taxes. You know, to put this little caveat on it, like, so then those two couples, but one has a mortgage. So now this one gets the mortgage interest deduction on their federal taxes. So they're not necessarily being treated the same. And when you're building the tax code, you tweak things that so they look the same on the surface, but there's some credits or deductions or something that impact them differently based on their circumstances. And then the other side is vertical equity, which is progressivity. So if somebody has more income, they pay more in taxes than somebody with less income, or a bigger percentage of their income in taxes than somebody with less. The next slide is just pulled from that ITEP report, has just an example of what a progressive system looks like. The income tax system that we have is a progressive system. As people's incomes go up, the percentage of their income that they pay in taxes increases. And then the tax type that we talk about is usually being regressive, is the sales tax. So people with lower incomes pay a larger proportion of their income in sales and use tax than people with higher incomes. And this next slide, so I'm on slide 9 for those following along. This is just this ITEP report, another interesting report if people are interested in looking at it, that sort of goes through each state. It's interesting to look at other states, I think, just in comparison, but it goes through each state and kind of shows whose income inequality is made worse by their tax code and whose it's not. Vermont falls on our state and local tax system doesn't worsen income inequality. It actually sort of narrows the gap between the lower and middle income taxpayers and higher income taxpayers. And that's mostly through, and that report is nice because it looks at the whole system, not just one state's income tax. It tries to aggregate across all the tax types that are paid in that state. And this one is this gap narrowing is driven a lot by the progressivity in the Vermont income tax system. So we were ranked 49 out of 51, includes the District of Columbia. So that's 49 or 51 being the best. So as of 2018, we weren't the best, but we were pretty close. Yeah, I mentioned that it looks at the whole state, the whole tax system. And that's a thing, that's just an important thing I like to remind policymakers of and to think about when you're making tax policy, is to really think about like the whole tax system, right? Like it's easy to get really narrowly focused on the specific tax being progressive or regressive or whatever, but thinking about it, how does it impact the whole system is important to consider. So over to slide 10, this is again from that same ITEP report. This just gives on the very bottom, those total taxes. That percentage is the percentage of income that folks pay in taxes. And you can see that if we were to chart it out, it'd be pretty much progressive, with a little bit of dip around that fourth quintile, but that's just interesting information, I think. And then on slide 11, we'll see this chart a couple times over the next couple of weeks as we talk about personal income taxes, but this line really shows the progressiveness of the Vermont income tax. So this is the effective tax rates by the federal AGI income brackets. And you can see as it's actually negative at the bottom end due to the earned income tax credit, which is a refundable tax credit. So people actually receive money from the tax department. So they have a negative effective tax rate because they get money back. And then you can see it slope up from there. On average, the effective tax rate in 2020 was 3.67. All right, so my questions. I'll go to simplicity. Hold on. So simplicity, meaning you want a tax system that's easy for people to understand and comply with, right? If it's overly complicated, people may choose not to comply with it because it's complicated to comply with. It's easy to understand, easy to pay taxes. It's easier to, people will likely have higher compliance.
And I think in addition to folks choosing not to comply because it's complicated the way you described it, I think also it's just much easier for people to not comply accidentally.
Yes.
Or to pay in order to comply, which places sort of undue burden.
Yeah. I used to do all my own income taxes and then something got complicated and I was like, never mind. Like, I'll let somebody who's a professional do this, right? But that means, I incur those costs. So as you're making decisions about that, thinking through how that impacts real people. Similarly, on the state side, you want it easy to administer. To the extent the tax department doesn't have to hire a whole bunch of people to work on administering it, or it doesn't create an undue burden on businesses to administer. And then it raises revenue efficiently. And it's important as policymakers, right? You want constituents who are informed and know how they're being assessed with taxes, that the sort of collection process and the compliance process works. So on slide 13, just as a high level picture of the Vermont's personal income tax. And I will save the excitement for tomorrow. Abby and I are doing the personal income tax presentation, but this is just on its face is not super complicated, right? You take your AGI from your federal form, add some things, subtract some things. That's your Vermont taxable income. And then from there you do credits and et cetera. But it's relatively straightforward for most taxpayers, I think. And before jumping off of simplicity, we'll talk about it a little bit more at the end, but fairness and simplicity, I think, are the two principles that are at most tension with each other often in the tax code. And I think when there's a work by policymakers to make the tax system more fair, that inherently introduces complexity. And that's where you sort of lose on the simplicity side. So trying to balance that is a challenge for all of you. So economic competitiveness is the next principle. And this is that the tax system is responsive to interstate and international competition. So recognizing that we don't live on an island, even folks that do live on an island have to think about this. Like Hawaii isn't exempt from thinking about this. And that we need to think about, and that people can freely move amongst in and out of our state or in and out of our counties, and making sure that there aren't unnecessarily high rates or compliance burdens that will cause people to behave differently as a result of the tax system.
Emily, curious your thoughts on this. I think it's sort of debatable whether or not people actually physically move based on all kinds of things that state governments do. But I think so I think of this more in terms of people migrating their money, and that higher wealth people tend to have money that migrates more easily.
Yes, I think that's, yes. And like thinking about a movement of people, there's like, it's hard to move your house, it's hard to move to your business. How is the tax code driving people to make those decisions? I'll use Brattleboro as an example, right? Like trying to figure out where I'm going to go buy cheese for the weekend, right? Like, am I thinking about whether or not, I can get it cheaper in Massachusetts because they have a lower, I don't know if this is actually true, but they have a lower tax rate on cheeses than Vermont does or whatever, and are people making decisions based on those characteristics of the jurisdictions nearby with different taxes. So on slide 15, this is the state-by-state comparison of the top personal income tax rates. And you can see that there's both variability in the top rate, but also in the level of income that rate applies to. So when thinking about personal income tax rates, it's important thinking about both sort of the level that it's applied to, but also what that rate is and what the rates are below that and what the levels are that those are applied to. And then New Hampshire, right? New Hampshire is missing from here. New Hampshire doesn't have an income tax. So
We don't like to look at that.
Yes. Well, and Catherine and I were talking about this. Should also point out for your awareness, they currently tax income from dividends and interest, but they are phasing it out over the next 3 or 4 years. In terms of ways that our tax code will be different, they will, if it gets all the way there, they won't have income tax on anything as of 2026, I believe.
So they hide it in fees.
They get you other ways, right?
Agree.
Yes. Yeah.
Well, they still retain, though, the tax on business payments of dividends? Or is that also going bye-bye?
Not sure.
I think they call it business enterprise tax.
Well-
I don't think they're doing away with that.
Yeah, and that's the sum of wages and dividends, as I recall, a rate applied
I
to.
think they have it mentioned.
Anyway, I'm sorry to get distracted, but
No.
that's their business tax.
One of the,
Yeah, which some people argue is an income tax. Yeah.
Value add.
Fortunately, we are not New Hampshire legislators. We don't.
All more this year.
more of just awareness for you all, as that often comes up as something I think people ask about. How do we compare to our neighbors, especially the neighbors? says slide 6, but that's not right. Slide 16, it's like something got moved. Is as a state-by-state comparison of the state level sales tax. Meals and rooms tax as a just point of comparison, that we're sort of in the same range as our neighbors on those things. The sales tax is the one that's a little, I talked about this on Friday, but New York is a little misleading that it's 4%, but New York has a lot more county level, city level taxes. So this is just the state level. This isn't what folks are actually paying in sales tax typically in some of those states.
And this also doesn't include all the exemptions that various states
Correct.
do not have.
Correct, yeah, this is just what the rate is. This does not contemplate anything about the bases, the tax bases in those states. All right, I'll go on to the next one. Tax neutrality. So this is the idea that the tax system itself tries to minimize unintended consequences. Often, or not often, but sometimes, policy is made through the tax code. So a lot of these are referred to as the sin taxes or the excise taxes on things to try to get people to, maybe we raise the tax on cigarettes so people smoke less because it's too expensive to buy cigarettes, or get people to drive less by increasing the tax on gasoline, for example. So sometimes there is a policy goal to sort of encourage or discourage consumption of goods and services. But we want to make sure that it's explicit that that's what the goal is of said excise tax. And an awareness that by putting those sorts of taxes into place, you may change how people are spending their money or where they're spending their money. And there's that sort of similar, people may make decisions based on those that may not necessarily align with the policy goal, right? Like we increase the cigarette tax to get people to smoke less, so they have the opportunity to go somewhere else to buy cigarettes, in which case that doesn't really achieve the policy goal that was intended. And, thinking about both how that impacts individuals, but also businesses. Everything on tax neutrality. Just check my notes. Yeah. Questions on that one? Keep going. And the last principle is accountability. So including tax systems should have explicit taxes. To the extent you can minimize credits and exemptions, that's, I don't want to say it's a good thing, but it makes it, this is the sales, we're taxing all sales of things. And then as you start to include exemptions and credits, it kind of changes that a little bit. Limit the amount of tax flow through. You want the person, to the extent you say, we want these folks to pay a tax on a certain thing, making sure that that's actually what's happening. I think one that gets an instance of this that gets talked about a lot is what happens with property taxes and renters. If the goal is to have the property tax paid by the individuals who own the property, to what extent does that get passed along through rent? And then how do you correct for that in the tax system, potentially? If the renter is not the intended entity to pay the tax, then they shouldn't be the ones paying the tax. So how do you figure that out? It's complicated, right? Yeah.
Is there a best practice for that sort of a situation?
Not that I'm aware of. I think it would depend on how you write the law and what the tax base is in terms of how explicit it can be in terms of who ends up paying.
One thing we've talked about here, or just tended towards here, is to sort of more towards the simplicity side, is that if we're going to sort of aim towards correcting towards tax neutrality, that we try to make it as simple towards the taxpayer. And if it has to be complicated, it should be complicated on sort of the department side rather than the taxpayer side, because we wouldn't want to put the obligation on the person who has already experienced whatever the opposite of neutrality is. Whoever was experiencing the unintended consequence, we also don't want them to experience the unintended consequence of extra paperwork.
Right. I think that the last piece of this too is, making sure that as tax policy is drafted, not like there aren't random credits going to specific entities, right? So minimizing that sort of targeting of this type of entity doesn't have to pay, like, and getting too specific and who it's subject to and who it's not. So that's the 6 general principles.
I'm going to add one more example for sort of the tax neutrality thing. So we often talk about exempting not exempting categories of income as much as building a tax system that's based on the amount of income that someone has. That was a big debate last biennium, but that's sort of another way we can achieve tax neutrality. That's not about where the income comes from, it's about the quantity of income that you have.
Cool. So the last 2 slides, I'll do those, the last couple slides at a high level, right? Like, so the ultimate question is it possible to design the perfect tax system sort of that balances all of these things and thinks through all of these things? I can't remember if I said this out loud on Friday, but I'll say it out loud here, right? Like, I think if we could have a perfect tax system, we would, right? And I think that's ultimately, not that someone would have thought of it, but that's where you guys come, is to try to get to that, achieve that sort of perfect balance of all of these inherent tensions within tax policy and within the system. So ultimately, figuring, if we're going to do X tax, is it more important that it's fair and that we ensure that as we implement this, folks who can pay do? Or do we want it to just be simple? Like, we're just going to broad brush it, keep a wide base, and make it easy for people to pay into it. And figuring out those trade-offs is ultimately what tax policy comes down to. So the one we talked about on Friday is, right, the idea of tax neutrality and influencing behavior. So balancing those things with things like those excise types taxes, whether or not, if we want to influence people's behavior through the tax code and put in taxes as such, will this sort of tax neutrality problem become an issue and people will start to behave differently as a result of those taxes that are intended to get them to behave differently, but maybe they're not going to behave differently in the way that the policy is intended. And similarly, simplicity versus fairness, which we've talked about a lot, but I'm going to keep hammering on. I alluded to it on Friday, but the property tax is one where there is that tension. You can really see that happening. There'll be a presentation on it later this week, but this summer there was a long conversation about shifting the non-homestead or the homestead property tax to an income tax to fund education. And a lot of the challenges were in that sort of, the property tax system is complicated. It's hard for people to understand. Nobody knows what they're voting for. Well, that's because we've adopted some things to try to make it more fair, right? We've introduced the income credit to people's property taxes to help reflect people's ability to pay versus the value of the asset that they own. And that inherently sort of complicates and makes it harder to understand. As opposed to just doing, everybody just pays one rate regardless, like, this is what your house is worth, this is what you pay, call it a day, right? We've introduced all of those complexities to try to make it a more progressive system. And the trade-off is not nobody understands it, but it's hard to understand, right, for the average taxpayer when they go, the one that I talked about on Friday is the sales tax, right? We do simple sales tax on everything, 6%, it is inherently regressive. So the legislature has made policies. Okay, so what can we pull out of the sales tax base to make it more progressive? And that, to try to introduce some vertical equity into the system. So by exempting groceries and clothing, medical supplies, those sorts of things, there's a whole, Pat will be in next week to talk about the tax expenditure report, which sort of lists out all of the things that are exempt from the sales tax. But in doing so, you enter you get the complexities around like, okay, well, these things, groceries are exempt. Well, what is a grocery? Right? And that's where the is soda a grocery, or is candy a grocery? Are marshmallows candy? Should they be included or not? And I put the sort of pictures of candy because the streamlined sales tax agreement, which you'll hear more about, says that anything with flour in it is not subject to, is not considered candy. So some of those things that you would think are candy are actually not considered candy from a tax perspective. That starts to complicate things.
I've
Yeah.
never heard that before.
No.
My assumption is that a Snickers, whatever the cookie you bought on many candy bars.
These two.
There, thank you. I'm not falling, yes,
If it's
not
crunchy,
candy.
it probably has flour in it.
Oh, I'm so excited about that.
Yes.
And
Kit
just
Kat.
for the committee's knowledge, if anyone gets really excited about the streamlined sales tax agreement, and I would appreciate if someone would get really excited about the streamlined sales tax agreement, because we usually have a liaison to the streamlined sales tax compact. And that person left the legislature a few years ago, and we have not found a new sales tax excited.
You get them
Number.
to Washington DC or something once.
I'm sure you get some really thrilling junkets to random small cities in the US, yes.
I would like, when we get to that point where we take testimony, I'd love to know, in a post-Wayfair world, how important Streamline still is anymore. I mean, we don't have to be part of it.
I think that we have some answers that we will get to, and maybe when we talk about sales tax explicitly.
Yeah, we can get there.
Okay. It's a great question.
When Streamline came to Vermont, it was sold to all of us as just a great boom. Tons of money. Didn't work out that way.
And it sounds like maybe we should spend a little bit of time on streamlined sales tax, which I don't think we have on the agenda yet, so,
That's a good tax department,
yeah.
for sure.
Yeah,
A couple things. Maybe it doesn't rise to being as important as these, but it seems that there's also a good tax system would have the thing being taxed relates to the tax. In that, when you're thinking, whoa, you're thinking, I might not have said that right, but for instance, gas is used to pay for roads
Nexus there, right?
as opposed to gas being used to pay for education or something. The tighter that connection, it seems to me, the better a tax it is. Because it's similar to your library.
yeah. I'm gonna answer that and spare Emily answering it. So, we call that nexus, right? Like that's the technical term for it. But that can create an enormous amount of complexity in the tax system where we have billions of little special funds that all need to be accounted for. And it also prevents us, it's one of those places where we're constantly balancing. It also can prevent us from having a good mix, a balanced system. Because then you might have a revenue source that's not as stable, connected to something that really requires a lot of stability because there's sort of a natural nexus there.
But is it a good thing to have a nexus that?
In my experience, the nexus is very helpful politically to get something passed on the floor, but doesn't actually serve the purposes of a progressive, high-quality tax system.
Oh, well, that's
There are exceptions, but
Absolutely exceptions, yes.
gas is one of them.
Yeah.
You go to Bronx, see how many miles you drive.
My other,
Unless you're an EV.
slide number 5, all the way back to 5.
Yeah.
That says amounts in millions, is that over?
Yes. Oh, no, that should be billions.
Yeah.
Good catch. I'm not used to numbers these big.
I didn't.
Yes, that should definitely be billions.
Okay.
We get more than $4.3 million in revenue. Good catch, thank you. Anything else? Great,
Thank you.
yeah. Let me know if you have questions. I'll see you tomorrow.
Are you coming back again?
Yes.
Okay.
Would you like to hear from me straight away?
I think,
Oh, yeah.
yeah. Thank you.
any break, Madam Chair? I need to just get some hot water.
Yeah,
Too early for that?
no, I